In this presentation, I will be talking to you about IAS 12, taxation. The objective of IAS 12 is to prescribe the accounting treatment for income taxes and how to account for tax on a company's profits. It requires an enterprise to account for current and future tax consequences of transactions and other events in the same manner they would account for transactions. So, the tax is accounted for on the statement of comprehensive income just like normal business transactions are accounted for. The standard is made up of two areas, current taxation and deferred taxation. I will go into more detail on these in the coming slides, but before delving in, first I'll explain the history of IAS 12. History. The standard was originally issued by the International Accounting Standards Committee in October 1996 and is appropriate on annual periods starting on or after the 1st of January 1998. But, in April 2001, the International Accounting Standards Board adopted IAS 12 Income Taxes, which replaced part of IAS 12 Accounting for Income Taxes, which was issued in July 1979. There have been a few adjustments throughout the years. One of these occurred in January 2016. An amendment called Recognition of Deferred Tax Assets for Unrealized Losses was introduced in order to recognize deferred tax assets relating to debt instruments measured at fair value. Firstly, we'll talk about current taxation. This is one of the two areas within this standard. It is the amount of income taxes payable or receivable in accordance with the taxable profit or loss for a period, which is then payable in respect of the current period. It should be recognised based on the year-end estimate of the tax payable. The income tax expense payable through the income statement is adjusted for any under or over provision from the prior year. It is calculated by multiplying taxable profit or loss by the current tax rate, with any overpaid current tax, which is recognised as an asset, and any unpaid current tax, which is recognised as a liability. An example of this, showing the accounting treatment for a current tax expense, will be shown on the following slide. It will be highlighted in the blue cells. As you can see in the example, after the tax profit or loss is calculated, the current tax expense can then be calculated. Therefore, this tax loss is then multiplied by the taxable rate given, which is 30%. This then gives us a current tax expense of £300 annually, which is then inputted on the income statement after profit before tax, as you can see above. Carrying on from the previous example, at the end of year 5, the entity recognises the asset, so the tax expense is totaled as they have recovered the benefit of the tax loss of £5,000 against the taxable profit. This can be seen in the orange cells. Now on to deferred taxation, which is the second area of this standard. Deferred taxation is the estimated future tax consequences of transactions and events in the financial statements of the current and previous periods. It can also be defined as income tax payable or recoverable in future periods in respect of the temporary differences of unused tax losses and unused tax credit. It is calculated by multiplying the tax rate by the tax profit or loss. Temporary differences. Temporary differences are the differences between the tax base of an asset or liability and its carrying amount in the balance sheet. It arises due to income or expenses being recognised on the financial statements and tax returns in different periods. These differences will cancel out over time due to liabilities or assets being carried forwards. It is calculated using carrying amount less tax base. If you look at the example below, you can see that in year 1, we calculate the temporary difference by taking the carrying value of £25,000 less the tax base of £19,000, giving a temporary difference of £6,000. Now on to tax base. A tax base is the amount attributed to an asset or liability for tax purposes, which is calculated using the cost of asset, which in the example is £30,000, less the cumulative amount deductible for tax purposes in the future periods, which is shown in the green cells. As you can see in the purple cells, liabilities is the tax rate multiplied by temporary differences. Firstly, we have the deferral method. The deferral method is calculated based on timing differences arising in the year. The tax effect is debited or credited to the income statement, and a double entry is made by putting an entry into the deferred tax account. This method ignores timing differences, so total provision may differ from the rate calculated in the year. The cumulative effect of the income statement is put under non-current liabilities on the balance sheet. There will be an example of this once I have explained the liability method. Firstly, now onto the liability method. The liability method is calculated based on timing differences, as at year end. Provision is therefore increased or decreased accordingly. The standard requires that company statements are prepared using this method. The total amount of potential liability is recalculated for the balance sheet provision. The movement in provision will then be entered into the income statement. The method of calculating deferred tax using the liability method is done by first calculating the cumulative timing differences as at year end. You then apply the current rates of tax, then you adjust the provision. This can be seen in the following example. In this example, an asset was acquired for £5,000 with a depreciation of 10% on a straight line basis and a capital allowance of 30% on a reducing balance basis. First, the deferred tax position using the deferral method must be calculated. Depreciation for the 5 years will be calculated multiplying the cost of asset by the depreciation rate of 10%. In year 1, for example, we do this by multiplying £5,000 times 10%, which gives us a depreciation of £500. Then we must calculate the tax allowances by multiplying the cost of asset by capital allowance. As it is on a reducing balance basis, we'll then total up the reduction each year and deduct it from the previous year's carrying value, giving us a total tax allowance of £1,500 and a £3,500 cumulative for year 1. To calculate timing differences and the cumulative timing differences, it is tax allowance less depreciation, shown as £1,000 in both year 1, both non-cumulative and cumulative. With these results, we can then complete the deferred tax deferral method, shown in the example following. As you can see, we take the timing difference for each year and multiply it by the tax rate to get the deferred tax charge for each year. In order to work out the provision, starting in the second year, we add together the deferred tax charged in the year with the previous year's provision. For example, in 2018, we take £138 and add this to £250 to give the total provision for that year of £388. Finally, we have the liability method. Just like before, we take the timing differences, but this time we also have a cumulative timing differences column. The provision is calculated by multiplying the cumulative column by the tax rate. This total is then inputted onto the balance sheet. To calculate the income statement charge, we take the previous year's provision less the current year's provision. Again, for example, in 2018, we take £250 less £388 to give us an income statement charge of £138, shown in the example on the slide. As you can see, now on to advantages and disadvantages. There are obviously some advantages and disadvantages when using a standard. I'll talk about a few of these now. Having a standard based only on income tax is beneficial to employers, employees, and external users. This is because it provides information and guidance on tax bases, as well as information on the treatment of income tax. In practice, having standards allows for all businesses and accountants following the same standard to produce financial statements that are aligned. This therefore creates uniformity across entities and accountants, which in turn makes it more straightforward for external users to follow and understand. However, as an external reader or student like myself, this standard can be quite simple to follow with prior knowledge to financial statements and taxes. But even with that knowledge, some areas can be difficult to grasp. So for readers who may be interested in a business and understanding this standard, IAS 12 may be confusing. It can also be a lot to understand and read, especially if you're having to read all of the other standards alongside this one. Overall, there has been an increasing move towards using the liability method as it includes timing differences with the current rate of tax. In my opinion, it is better to follow the deferred tax liability method as it takes into consideration timing differences with the changes of provision with current tax rates that are then recorded on the balance sheet, with also inputs into the income statement, whereas the deferred tax method, there are timing differences due to total provision being calculated using different tax rates. Overall, it is an important standard to have in the industry, as taxes are a large part of companies' financial statements, that can easily be worked out incorrectly, so having this standard allows for clarity and uniformity across the industry.